Good news this morning, and right when we needed it most. Let's talk the Fed and funding today on the Weekly Update. Okay, friends, let's talk the Fed and funding. Now, today's news review is going to be about some pretty wonky, esoteric finance stuff. So I'm actually going to go pretty quickly through the news, and I'm going to spend more time on the implications and what it means, because I think that's the important part. So first up, here's what you need to know. The Fed meeting results will be announced later today. Now, as I'm recording this is before the rate announcement has been made. However, I feel pretty confident that the Fed isn't going to do anything. Here's the rate probabilities for the November 1st Fed meeting. Our current range is 5.25 to 5.5. 99.5% probability that they're going to leave things alone, 5.25 to 5.5. And a 0.5% probability that they may even cut. They're not going to cut, they're going to leave rates alone. So that's my expectation, that's what I think, but of course the data release hasn't come out yet. I could certainly be wrong, but I don't think so. I think everybody knows they're going to leave rates alone at this meeting. The implications of that are pretty important though. I think that the market is slowly coming to grips that the Fed may be done tightening. And this is important for a lot of things. When you're in a rising rate environment, it can sort of make it difficult to plan over the long term. If we build a factory, what kind of financing are we going to get? When I'm building a new home, what's my mortgage rate going to be? So I think that reaching the peak of this rate hike period, I think is going to be very important and very positive for growth in the future. We don't need rates to come down immediately, they just need to stop going up. And even if we need to keep them higher for longer, that's okay. But I think the end of the hiking cycle is something that's going to be important. And so if the Fed pauses at this meeting, that's 2 meetings in a row that they've paused, and I think it's going to be a signal that, hey, I think they're done. So that's positive. Second most important thing you need to know, the Treasury funding expectations have been announced. Basically, what the Treasury came out and said is, they said, we're going to be raising $1.6 trillion in debt to fund the government over the next 6 months. And that's a little less than expectations, but certainly that's spending a lot of money that we didn't have. However, the way that they said they were going to raise this funding is what has the market moving in a positive direction. They said that they're going to issue more short-term debt than long-term debt. Now, I have a video about the rate shock. It's about a 5-minute watch. It'll get you up to speed on what's going on. But essentially, if you don't want to watch that video, what was happening was the government was issuing so much long-term debt, it was more than the market could bear. And that's what caused 10-year rates to rise, 30-year rates to rise, and that was also pulling mortgage rates up along with it. By signaling that they're going to issue more short-term debt than long-term debt, the Treasury issuance that caused the rate shock is alleviating for now. We have this thing called reverse repo. There's about $1 trillion there in short-term seeking sort of investments. That $1 trillion is going to absorb all the Treasury issuance, at least between now and the end of the year. So what this tells me, this is a green light to the end of the year. In the future, as we start to get into the first quarter next year and beyond, that $1 trillion in reverse repo, that piggy bank is going to draw down to zero. And so we're no longer going to have that support. But at least between now and the end of the year, I would say that the rate shock that I talked about in that last video, the rate rising on the long end of the curve, I think it's probably done until the end of the year. What does it all mean? Well, this weird esoteric Treasury funding, interest rates, what does this mean to you? What does it mean to the stock market? Well, this is my personal opinion, but I think that this was the best possible outcome for risk assets. Stopping the rate rise on the long end of the curve, keeping rates where they are, potentially signaling that we're at the end of the hiking cycle. These are all really big positives for growth, the economy, and the markets. Not surprised, it's early, and I never like to talk about the market while the trading session is still open, but I'm not surprised that, at least right now, the market is lifting in response to this news. Hopefully, Jay Powell doesn't ruin the party this afternoon when he talks about interest rates. This data, the way I'm interpreting it, if you followed me for a little bit, then you know I think we're coming down and we're doing a test of the 200-day moving average, and I think it's going to resolve positively, and we're going to have a good fourth quarter. This data today helps support my expectations for all of that. So it's a big win for me. I'll take it. And then finally, if there's one fly in the ointment, problems may arise in the future. What I mean by that is we can't keep spending 1.6 trillion that we don't have in a 6-month span of time. So the government has to get their spending under control somehow. The economy needs to grow, they need to spend less, or the worst case scenario would be they need to find it in taxes. But one of those three things needs to happen. So reverse repo and the Treasury issuance is going to keep us relatively insulated until the end of the year. As we start to get into next year, that's where things are going to be important. But today was a big win, really good news, and I'm interested to see how the session ends today to let me know if I've got the correct read on all of this. That was our video. That's the news review. I'll see you all Friday for the markets review. Take care.